if we get a recession, normally tax receipts suffer in that environment, both because asset prices are falling and because unemployment levels are rising. And yeah, we're already running a $1.7 trillion deficit going into it. So if we do get a recession, the interest expense portion of the fiscal deficit will ease, most likely, but the other parts will worsen.
Lyn Alden discusses the potential impact of a recession on the economy. Alden points out that during a recession, tax receipts typically decrease due to falling asset prices and rising unemployment levels. She anticipates a scenario akin to stagflation, where certain sectors thrive while others stagnate. Those in industry-sensitive sectors might face challenges, especially if they are in commercial real estate, have credit card debt, or rely on bank loans. Alden emphasizes the importance of understanding the diverse effects of higher interest rates on different sectors. Regarding investments, Alden advises caution in the stock market, anticipating a volatile and choppy pattern. She highlights the historical underperformance of U.S. government bonds, suggesting a focus on assets like equities, cash, gold, Bitcoin, and commodities. Alden also discusses the evolution of financial technology, emphasizing the decoupling of transaction speed and settlements, leading to a shift away from traditional hard currencies like gold toward fiat currencies, which prioritize speed and centralization. We will now bring you clips from Alden's recent interview. Also, make sure to hit the like button, subscribe, and drop your comments below.
And so I expect more of like a stagflationary type of condition. And another way of phrasing it is that we have a tale of two economies. If you're not an interest rate sensitive sector, you're either booming or at least you're fine. You know, if you're a upper middle class retiree that has a very large cash balance, money markets, T-bills, and either, you know, no debt or fixed rate mortgage locked in, you know, you're fine. And if anything, if the Fed increases interest rates, that just means more income for you, right? And so that's not going to affect your travel. It's not going to affect your ability to go to restaurants. Some of them even help their kids and grandkids afford their kind of first property, things like that. So you have some degree of just kind of things that are happening there. On the other hand, if you're in commercial real estate, if you have credit card debt, if you're a junk rated business, if you're a small business relying on bank loan financing, many of these businesses are very much pressured by this higher rate environment. And so, and this actually goes back, if you look at it, recessions in emerging markets, they often look different than recessions in developing countries. Instead of like this big uniform thing, you have, okay, this one sector, like these exports and they're booming, and this other sector is completely stagnating. And I think that's what we're going through here, where it's very sector by sector, whether or not you're harmed by higher interest rates or you're on the right side of the fiscal deficits. That's kind of the delineating factor. And overall, like I expect higher average background levels of inflation, which can go down in a recession. It can go up when you're coming out of a recession, but that the average is basically higher than the 2010s, just because there's these higher background fiscal deficits. And so right now we're seeing mixed results when you look at most metrics. So most economic indicators have been decelerating from a positive base since late 2021. Which is roughly how long it normally takes. Right now, it's kind of getting long in the tooth, but it's, you know, roughly the 18 to 24 months of deceleration is normal. And some of them indicate mild recession, but other ones are turning back up. Like they're actually showing signs of stabilization from a low level. So if you look at purchasing managers indices, if you look at conference board leading indicators, some of these are actually turning up from a low level. And that's because we just have a very unusual environment. So I take things on an industry by industry basis, and I generally have a more stagflationary type of outlook. So for example, I don't think the S&P 500 is going to do very well this decade in real terms from its late 2021 high, right? I think that's, instead of the market going straight up like it did to the 2010s decade, I think it's going to be a choppy, volatile pattern. And then especially when you count for what is CPI doing, what you can earn in T-bills, it's just not going to be an attractive market overall, because the economy is more in this kind of stagflationary type of situation. Well, this was the worst 3-year history in bonds ever. I mean, basically going back to like the founding of the United States. U.S. government bonds have never done this poorly. If anything, the most useful thing in my portfolio has been just not being long bonds. I've had somewhat mixed equity selection success. I've had somewhat mixed, certain things are mixed, but the biggest things have just been getting the big picture right on macro, which is expecting inflation, avoiding long duration, low interest rate bonds, and focusing more on either equities or cash or gold or Bitcoin or commodities, energy producers, things like that. That's been the winning strategy, and that normally works in a more stagflationary or inflationary environment. And of course, again, there nothing is linear. So even in the 70s, there were disinflationary impulses within an overall kind of very inflationary decade. And that's the challenge of navigating this. But yeah, I think having that stagflationary outlook helps you gear your probability weightings in your portfolio to avoid the assets that do the worst. So the main thing I would say is a technological shortcoming. That the way that I describe it in the book is that there's a couple different eras. So up until the invention of the telegraph, matter and information moved at the same speed, more or less. So humans could not transmit complex information any faster than they could travel on ship or horse. But once we invented and then deployed the telegraph, which didn't really happen until like the 1860s, and then continuing from there, at that point we could send information around the world at nearly the speed of light, while physical settlements and physical matter could still move slowly. And if you can send information, you can send transactions. And so we completely decoupled the speed between transactions and settlements. And so that allowed for a lot more, and it even necessitated credit abstraction, things like that, because some entity, when banks around the world or entities around the world are basically updating each other's ledgers electronically, and yet they're still expected to settle in gold eventually, that gets arbitraged with IOUs. And that became very centralized, very abstracted, and eventually broke because it was a very fragile system. One of the references I cite in the book is Jevons' 1875 book, The Money and the Mechanism of Exchange. And he's talking about how this system is super efficient and increasingly centralized, and in some ways beautiful, but he's like, this is also levered 20 to 1. If 5% of people ever show up and want their gold back at once, this whole system runs into a brick wall. And of course, that's what happened in World War I. And so they basically the whole system broke. And so for the past century and a half, we've been in this environment where transactions go a lot quicker than physical settlements of sound money. And so we've increasingly decoupled from sound money, eventually just dropped it entirely. First it was like, okay, credit grows faster than the base money, and then it's okay, break the pegs, change the pegs, and then it's just disregard gold entirely and just keep it as kind of a reserve asset on balance sheets somewhere. And we've just kind of had takeoff. And the way I would describe it is the first time in history where we've taken a step back in terms of monetary hardness. So for most of human history, we're going up the hardness scale. We were going from shells to copper to silver to gold in terms of what we use as our money. And basically getting, scarcer, slower supply growth types of monies. But with the fiat currency era, speed became an issue for the first time. And so we actually took a step back in hardness in exchange for more speed, more centralization, things like that.
In conclusion, Lyn Alden's analysis provides valuable insights into the intricacies of economic dynamics and investment strategies in the face of potential recessionary challenges. Understanding the sector-specific impacts of economic shifts is essential for making informed financial decisions. Alden emphasizes the importance of diversification and cautious investment, especially in the stock market, which she predicts will experience volatility. Her discussion on the evolution of financial technology highlights the trade-offs between transaction speed and the historical concept of monetary hardness. It's crucial to remember the diverse effects of economic changes on different sectors, ranging from industry-sensitive businesses to individual investors. Being mindful of these nuances empowers us to navigate the financial landscape prudently. Stay tuned for more valuable insights and analysis to guide your financial decisions in these uncertain times.